Ladies and gentlemen, we have breaking news. Trump and China's President Xi spoke on the phone for about an hour and a half today, and we're getting some of the details, and markets are liking it so far. But first, Trump says the call with Xi bore positive results for both the US and China. Trump says the conversation was focused almost entirely on trade. Nothing was discussed concerning Russia, Ukraine, or Iran. Trump says, quote, "Our respective teams will be meeting shortly at a location to be determined. We will be represented by Secretary of the Treasury Bessent, Secretary of Commerce Lutnick, and USTR Ambassador Greer." Trump says the call lasted approximately 1.5 hours and resulted in a very positive conclusion for both countries. There should no longer be any questions respecting the complexity of rare earth products. This is what I was talking about. It's the rare earths for the US and it's semiconductors for China. That's kind of the area of contention, okay? We want rare earths, China wants semiconductors. I'm sure a deal, that at least the framework of one, was outlined in this call. Hey, you give us rare earths, we give you semiconductors. That is going to end up being very positive for NVIDIA. And I mean, NVIDIA's chart alone looks very bullish, but just wait until that news comes out that there is way less chip restrictions on China. I believe that's coming soon. Following this call, China's President Xi says the US should avoid a very small number of Taiwan independence separatists, dragging China and US into dangerous situation of conflict and confrontation. China's president also says the US and China should avoid conflicts because of Taiwan. China's president says dialogue and cooperation are the only right choice for China and the US. And he says the US should deal with Taiwan cautiously. He says that both sides should make good use of established economic and trade consultation mechanisms. And China's president says consensus has been reached and both sides should abide by it. And President of China Xi says it's important to dispel disruptions to China-US relations. And according to state media in China, China's President Xi and Trump agree to start a new round of talks ASAP. China's President Xi says the two sides should enhance exchanges in diplomatic, economics, trade, military, and law enforcement. And President of China says Trump is welcome to visit China again. And President Xi tells Trump that China implemented the Geneva Agreement. He says the US and China should reduce misunderstandings. He says the US and China should increase cooperation on economy and trade. He says the US should remove negative measures on China. And this is what we talked about on the channel for the last couple of days. This phone call was never going to be a disaster. This phone call was only ever going to be a positive. Okay, now we need more details. There's still more talks to come. The deal's not finalized. But what it sounds like we're very close. That we're going to have some very positive outcomes here. And just, again, my belief is in order for China to give us rare earths, China wants semiconductors. And I believe that is something that will get etched out and will be a part of the deal, which is going to be very good for NVIDIA. It's going to help boost the broader markets and overall be very positive for the AI sector. There's nothing like advancements like a silent Cold War, right? Without the Cold War, we wouldn't have had many of the advancements in society and technology that we have today. They would have taken a lot longer. Again, when you have a fire under your ass, you tend to get things done. Okay, when you have competition, when it's do or, kill or be killed, essentially, you get progress. Okay, so that would actually be very positive for the AI sector, for economic growth, for the economy. That's a big tail on the bell curve that nobody's even thinking about right now. Just having a little bit of competition with China, would be huge. Japan's economy minister says there's no change in their stance. We want a full U.S. tariff reprieve. U.S. House Speaker Johnson and Elon Musk are set to speak on Thursday on the tax/spending bill. And the U.S. tells the U.K. it must spend 5% on defense. Now, we did get some bad news in economic data today. The initial jobless claims came in at 247,000. The estimate was 235,000, and last week was 239,000. So there's definitely a little bit of weakness in the labor market as it looks like right now, but not enough to be super concerned. Now, the balance of trade today came in at negative 61.6 billion. The estimate was negative 94 billion. So that's a less of a deficit, which, you know, is positive for GDP, but maybe not great. We'll just have to see. Exports came in largely in line with expectations. Imports came in weaker than expected, weaker than last month by about $70 billion. So that's quite a drop. That's pretty much all we had today for economic data. We did have challenger job cuts, which came in at almost 94,000. The estimate was 120,000. So that came in lower than expected, which is just planned layoffs from companies. So that's a little bit of good news today. But the big data is tomorrow with non-farm payrolls. You're expecting around 130,000, and the unemployment rate is expected at 4.2%. That is going to be really big data. And then any follow-up we get from this Trump, Xi call is obviously going to move the markets as well. And I think the markets are actually, underplaying the progress and the news that we got. The positive news that we got out of this phone call. Markets currently up about 1/3 on the SPY. I do believe this should probably garner close to a 1% positive reaction in markets. And I'm surprised we're not up more. So don't be surprised if tomorrow's a pretty big day. Now, here on the day today, percent of stocks trading above their 50-day moving average at 68.23%. So that looks pretty good. Again, you're on the high side of the last couple of years, but there's room to move higher. There's room to move lower. It just tells you where markets are as far as the breadth and the strength, which is pretty good right now. The CNN Fear and Greed Index yesterday was at 54. Today it jumped to 62, which is almost in the midpoint of greed. So, looks pretty good there, but still room to go either direction. Market momentum still in fear. Stock price strength is greed. Stock price breadth, extreme greed. Put and call options, greed. Market volatility is neutral. Safe haven demand in extreme greed, and junk bond demand currently in greed. You also got a new AI investor sentiment survey today, which is almost exactly the same from last week. Last week, you were at 32.9% of investors that are bullish. This week, 32.7%. So barely a drop, but a little bit of a drop. Neutral investors rose from 25.2% to 25.9%, and bearish investors fell from 41.9% to 41.4%. So bullish investors and bearish investors both fell, and all of the rise was in the neutral category, which is fascinating. I mean, you still have almost 10% more bears than bulls. So from a contrarian perspective, this is bullish. There is room for markets to go higher. And markets, I know you guys have heard this before, but stocks need to climb a wall of worry to go higher. Okay? There is definitely a wall of worry right now. We also do have some earnings today in after hours with Broadcom, DocuSign, and Lululemon, which can be important for markets, especially Broadcom. Tom Lee today is out again on CNBC making the bull case for equities and why he thinks stocks are going to continue to move higher. Take a listen to this.
Major averages pulling back this morning, as we mentioned, still just a few percentage points from those record highs. Our next guest calls the markets push higher from the lows, quote, the most hated rally. Tom Lee joins us, Fundstrat Global Advisors, Head of Research and CIO, joins us here at Post 9. Tom, it's great to have you back.
Yeah, great to see you all.
Why do you think it's been so hated? Because April was so sort of near death?
Yeah, I think It's hated because not only was it near death, but it was a dire economic scenario that in people's minds is still unresolved. And yet the markets have rebounded the entire decline and actually now approaching all-time highs. So it's been too fast, and I think a lot of people liquidated and then never got back in.
Which part was too fast? The rally or the April lows?
Both. It was a waterfall decline.
Yeah.
And we look back since 1900, of the 12 waterfall declines previously, almost all are V-shaped bounces, except for 2022. So I think it aligns with history. But even on my way here, someone stopped me and said that they're, just a person who watches CNBC says they're still bearish. They don't understand why markets have rebounded. I think the majority of people are bearish.
People stop you on the street to tell you that they're still bearish?
And then what do you say when they say they're still bearish? Do you
say bye, right?
What do you tell this person?
Well,
you probably love that.
This person watches CNBC because he was telling me that he's like...
Many people watch CNBC,
A lot of
Tom.
people.
Many, yes.
Yes.
We get stopped all the time.
Yes.
But what did you say in response to I'm still bearish?
Well, they said PEs are too high, and I said, but the 10-year can come down because Powell thinks there's inflation risk premia in the 10-year yield. And if that comes down, then PEs aren't expensive.
So I do wonder with that as your bull view that rates can come down. So I mentioned the weaker jobless claims today and how that's sort of creeping up. I've sort of been sprinkling in some weakness in the jobs market. Do you think that the stock market will be able to withstand that if we really start to see weakness in jobs because it means Powell's going to be closer to cutting?
Yeah, it's a good question. Joe Weisenthal called it like a slow leak in the economy, and I think it's accurate because there has been this shock. We know that like in the Beige Book, port volumes took a hit, trucking took a hit, but is that just a blip or is that the start of a downturn? And I think the markets are going to be able to suss it out eventually. But I mean, so many stocks are acting well and the guidance has been better that I think it feels more like a blip.
You now have the Granny Shots ETF, GRNY.
Yes.
This was a sort of a framework that you devised a couple of years ago, right?
Yeah, 7 years running. It was originally a core research portfolio called Granny Shots, and now it's the ETF.
So what's the construction of it these days?
It's 34 names, still concentrated, and it's focused on the themes like AI, cybersecurity, automation, monetary policy easing. We're glad it survived the Black Swan event this year because
it filled that gap. Yep.
Yes, yeah, and outperforming this year by 500 basis points. So it's a good year for Granny Shots. But I think it's a reminder that we try to get investors focused on long-term themes. Like AI doesn't really care about tariffs long-term, and cybersecurity doesn't care about tariffs. And so these are the names that, as you get through that, as that noise lifts, the stock should recover.
Have you been unnerved by any of the macro data that suggests maybe data center construction, manufacturing that second derivative is slowing a bit?
Well, the second derivative should eventually slow. But the need for AI and the innovation that's coming really is driving a lot of innovation. And when there's innovation, that's where economic value add comes in. So I think so much of global GDP the next 10 years is coming from AI and cybersecurity. And
I also want to share this clip with you as well. It's from Deutsche Bank's Bankim Chadha. It says, positioning has plenty of room to go up. Again, this is part of the bull case right now that people are so negative, they're underpositioned, that especially when you get towards all-time highs again and you break all-time highs, that's where the chase starts. That's really where things are going to get pretty crazy. In my view, again, I believe we're going to see a 20% rally into year end. So, yeah, you need to see positioning go up.
Post 9, Deutsche Bank Chief U.S. Equity and Global Strategist Binky Chadha. Binky, it's great to have you on. Let's start right there because you put out some research that's pretty constructive here. And you had basically said back in late April that if you start to see this evolution of trade policies, you start to see a movement towards more deals or even just a backing off on the rates of tariffs, we could see a rally. That has happened.
Exactly. I think, sort of the key question here is the market's obviously from the bottom up, around 20%. And so the perception is that, it must be running out of steam. Everybody must be getting overweight and, the market's overbought. What I would emphasize is that if you look at our measures of equity positioning, market's still actually underweight, pretty significantly so. I mean, I would characterize in bigger picture as like a moderate underweight, but we are sort of, on a Z-score basis between +1 and -1. We're sitting at -0.5. What I would also emphasize is that if you look at systematic strategies, it's way lower at about -0.8. And if you look at the last week, what you basically see is the S&P 500 basically, moving up and down, but basically within sort of 60 basis points. So as ranges come down, vol comes down, and systematic strategies have to raise exposure. Now, the market's about the discretionary investors or the fundamentals-based investors, and they're basically sitting at neutral. So, we think positioning has, plenty of legs basically to go up, plenty of room to go up. If you think about the tariff impact, I think, to us, the biggest indicator is, if you look at the consumer companies reporting, they're very vulnerable to tariffs, but we don't really see any signs of anybody going sort of back into the bunker. People are reporting, the company the other day said second quarter earnings going to be down 40-50%, in part because of tariffs. Stock's doing just fine.
Dollar trade just this week.
Because we're expecting an acceleration in the second half. So what I would also say is the tariff hit has come down. And the coming down is pretty significant. So we had a 15% hit previously. Now we're talking about a 5% hit. And 5% hit is arguably, within normal variation. Of course, at the upper limits.
So let me know your thoughts on all of that down below in the comment section. I agree with the bulls here. There is underpositioning. People are way too bearish, and odds are things are not going to be nearly as bad as most people think. And there's going to be a chase into year end. I actually think the S&P is going to go up 20% from here to hit about 700 on the SPY by the end of this year. I know that's 6 months. Like, that's a crazy projection. But that's what I could see happening, especially if this U.S.-China trade deal comes to fruition faster, again, than most think. And I do think we had considerably more progress today in getting there than most of Wall Street thinks. And I think that's really just representative of the rally we're seeing. S&P's up about 0.43%, 0.5% or so, give or take. I think we should really be up more than that, because I think we had more progress than what Wall Street is currently, expecting. Now, tomorrow, again, big day, non-farm payrolls, expecting 130,000 job ads. Last month was 177,000. With the rise in initial jobless claims and the horrible miss on ADP we had yesterday, you really need to see non-farm payrolls come in at a healthy number. Like, if we get a big miss there, you're going to start to bring up more of those recession fears. Yes, it could mean the Fed maybe gets pushed to cut rates a little bit faster, but that recession fear is always going to outweigh any positives from the Fed reducing rates. Okay, so that is a big one to watch tomorrow, as well as that the unemployment rate, does that move up or does that hold steady? So let me know your thoughts on all of this down below in the comment section, ladies and gentlemen. I will just tell you, look at the S&P from a technical perspective. This thing wants to break to new all-time highs. I think that could be coming very soon. Again, I'm not a financial advisor. I'm not a financial planner. Come to your own conclusions, but that's my general conclusion as of now. So let me know your thoughts on this down below in the comment section. Have a great rest of your day, and I will see you in the next one.